things were moving in the positive direction till the time this happened.
So where does the meaningful alpha really come from?
The contrarian buying.
How do you understand, how do you predict whether these Indian IT companies will be able to catch up with the AI revenue or not?
The challenge and the confusion which investors have in their mind as far as IT services companies are concerned is their legacy portfolio.
What all investing themes are you most excited about in that?
The trend in last 5 years has been on EV. Whenever I am particularly looking at a stock to buy, I am looking at least 2:1 kind of a risk reward. If this conflict remain for at least 6 months to 1 year, then annually the burden on the country would be upwards of 4 to 5 lakh crores.
So what's your take on the debate of large caps versus small caps versus mid caps?
I think in order to make big money in a small cap, I believe that you need the...
Hi everyone, I'm Shivank, your host for today. Welcome to the ICICI Prudential Fund Manager series. Today we have with us one of our star fund manager, Mr. Vaibhav Dusad. And here with us to share and decode his market insights. Thanks a ton for doing this, sir.
Thanks.
Let's start with your understanding of the economy and how are you positioning yourself with everything which is happening around the world?
So I think if we just go maybe 1.5 months back before the start of this conflict, India macros were quite good and stable. Most of the things were working well in terms of inflation, current account deficit, balance of payment, possibility of improvement in the credit growth, acceleration of GDP. And we were looking at a phase where earnings downgrade cycle would have bottoming out. And the reason for constructive macro was also several initiatives which government took. Let's say in last 12 months, what has happened is the cut in the income tax rates. There has been also a cut in GST, which has a huge benefit for middle class and let's say some of the urban poor as well because of all of these measures. So before this start of the conflict, what we were looking is towards accelerating growth in consumption sector, and the expectation was that 12 months down the line, the pickup in the consumption would also lead to gradual pickup in the private capex. So if you look what has happened in last 7-8 years, is that government has done bulk of heavy lifting in terms of new capital formation, right? Government was spending roughly around 3 to 4 lakh crores, maybe pre-COVID, and that actually increased to 12 to 15 lakh crores central government capex. This has a huge benefit in terms of multiplier impact, which you also see in good growth in cement and let's say steel industry in terms of volumes. So I think these were the macro situations before the start of the conflict. Now I think in last 1.5 months, it looks like there are pressure on Indian macro because what is happening is that if this conflict, let's say, remain for at least 6 months to 1 year, then annually the burden on the country would be upwards of 4 to 5 lakh crores. This includes your higher oil prices and the impact from the LPG subsidy. So from somewhere this will something
has to fund this.
Something has to fund this basically. So I think that is a challenge, and on the top of that, because of this situation, there is a pressure on the currency, and there is a pressure on the liquidity as well. So right now, I think RBI is able to manage both currency as well as liquidity, but nevertheless, there is a pressure on these two factors as well. So the hope is that this conflict would unwind soon, and as and when that happens, I think we would gradually back to better macros. But easing out of this conflict is very important for us to get back onto the growth track.
And do you track micros as well?
Yeah.
So what's happening on that front?
As far as company specific things are concerned, I think we were looking for a moderate oil prices before the start of the conflict. There was some increase in the commodities, but those were manageable. And to that extent, let's say in auto sector, there's a very healthy demand pickup. In FMCG also, demand was improving. So in many of these sectors, and there was some initial sign of pickup in the private capex as well. Some initial sign of pickup in cement as well. So many of these sectors were gradually improving before the start of the conflict. In fact, credit growth also improved in the month of January and February. So things were moving in the positive direction till the time this happened.
I want to pick up industries, sectors, and align that with your fundamental approach, which is you take some structural bets and you take some cyclical bets. Help me understand what's happening structurally and cyclically in these following industries. And we'll go in a priority sector which doesn't impact with the current macros and micros, which are in favor of these. So let's say example of the pharma. What's the structural thing happening and what's the cyclical thing happening, and how is the current macro and micro impacting this?
As far as pharma is concerned, there are two parts of pharma. There is one US generic, which is an export industry, and the second part is the domestic pharma. I think I am bullish on generic pharma. Generic pharma has gone through a pain cycle of if you look from 2015 to 2019. What happened during that period was there was a consolidation of buyers. That was one. And the second thing which happened is that there were many new entrants in the market, which is US generic markets. Now, in last 4 to 5 years, what has happened is that the consolidation of buyers has peaked out. There is no more consolidation. There is a consolidation on the supplier side as well. And I think as far as Indian generic pharma is concerned, we roughly have 30 to 40% volume share by prescription in US, which is massive. And we would have 15 to 20% maybe value share. So I think these generic medicines saves a lot of money for US. And I think if you look at ROEs for many of these pharma companies on an aggregate basis, when they are running a US business, they are not very high. They are anywhere between 15 to 25% range. And it's not easy to scale up US business. The compliance costs are very heavy. It's only when you reach to a certain scale of $400, $500 million, at least kind of a revenue, then you're able to make some kind of ROEs in the business. So as a result, there has been a supplier consolidation. I don't see many new companies coming into US generic market. And I think the significant price erosion which we saw during period of 2015 to 2020, that phase is behind. There would still be some price erosion, because if there are drugs where there are only one or two player and if third player enter, there can be some erosion. But a commodity piece of US generic where there are already 5-6 players, I don't see there is a room for further price erosion in that category. So to that extent, this base is stable. And I think this piece of stability of generic prices in US is something which I feel is now moving towards more structural in nature.
And overall, this is also an isolated thing. Whatever happens, whatever conflict happens, people will continue to buy the drugs.
Yeah, so that is insulated, right? So it is not dependent on any of the economic cycles, whether it is recession or it is less connected in some way it can be, but it is less connected towards your commodity cycle as well. So it is insulated in many manners, and therefore it is truly a defensive sector.
What about the upstream oil companies?
So I think my view is that post this conflict, we may not able to see the lower oil prices, which we saw before the start of this conflict, at least for a year. And to that extent, I think upstream companies is an interesting opportunity in India and outside India, I think, because in many of the cases, uh, most of these upstream companies valuations, they are discounting crude at maybe $55-$60, which looks tough, because I think whatever has happened in last 1 month, plus there would be a backlog of demand, and most of the countries would also try to, as and when this conflict get resolved, then the first reaction would be most of the countries would also try to backfill their reserves. So I think it would be a gradual correction in the crude prices, but it still may not go to the previous level, at least for a year. And then from there on, we have to see how demand and supply shapes up. But I think and in that context, I think upstream oil companies looks interesting.
Help me understand your thesis and the structural trends in the private banking sector.
Last 2 years, the stocks have not performed as far as large private banks are concerned. And I think even since COVID, the outperformance has not been significant. So this is a sector where actually the valuations are quite comforting, and the sector has underperformed also. What was happening in last 2 years, as we all know, there was an interest cut cycle. So RBI has cut rates by 150-200 basis points, and that has an impact on NIM trajectory for these large private banks. That cut of the interest rate cycle is largely now behind. So going forward, what we expect is the stabilization of NIM followed by pickup in the credit growth. However, there is a one caveat. So the caveat is that generally banks would only work in a good or a stable macro. In the current situation, if this conflict lasts for 6 months to 1 year, then I'm not clear if the private banks would able to give good alpha.
What about the AI and the internet companies, which is, I think, your third largest fund?
Yeah. So it's a combination of multiple themes. If you look internet companies, what is happening is that these are new age companies. Their tech stack is very recent, new, and most of them are in categories of startups and grown startups, mature startups, whatever you want to tell. So the advantage of AI, which these companies are observing, is that their tech spend actually has gone down. It has not gone down, but many of these companies actually they are growing at 30, 40, 50%. But despite that growth, they are able to manage that growth with a similar technology spend. And that is what is getting reflected through AI productivity which they have. If you look 2021 to 2023 period, the inflation in salaries for technology sector was quite high, and it was very difficult for many of these homegrown internet companies or platform companies to manage the tech cost. So that is getting eased out now because of AI. They get maximum benefit of this because most of their stack are on cloud and they are relatively on a newer technologies. So they get the most benefit out of this AI. And the second piece, which is of course connected with AI, is our technology services companies. What is clear to me is that IT services companies would need to change their business model. Let's say over next 3 to 5 years, things would move from time and material to more of a solution-based model, which would be more innovative in nature, and it would be more proprietary in nature. So the business model would change over next 3 to 5 years. There would be a few winners and few laggards in this transition. But I think what I have seen in last 25 years, IT services have gone through multiple technology migrations. and they have managed it well. There was a wave of ARP, then there was a wave of digital, then there was a wave of cloud, and now there is a wave of AI. So the hope is that they will tweak their business model and make themselves fit to again win in the market.
And I think this is India's largest technology fund that you manage, right?
Yeah, this would be the largest.
How do you decide the allocation between the Indian one and the US equity, US tech?
So US technology is largely predominantly software led. Indian technology is largely services and mix of few internet companies which have come up in last 5 years.
And how do you decide the allocation?
So the fund is predominantly domestic allocation. Fund has predominantly allocation in domestic sectors only. There are very few companies in US where we would have invested because of trends in AI or expansion or acceleration of growth in SaaS-based software, which of course would have some impact now because of AI.
This was economy, sir. What's your take on the debate of large caps versus small caps versus mid caps, and how has that changed over last recent 2 or 3 years?
So I think small and mid caps would have and it more so small cap would have underperformed large caps in recent time, but large cap performance has also been weak, and that is also because of FI outflows. So whenever there is an FI outflow, which is actually what is happening since quite some time, it does impact large cap. In terms of valuations, if you look, I am still reasonably more comfortable when it comes to large cap versus small and mid caps.
Why is that?
The PE multiple and the durability of the growth, the combination of these two looks better in large cap versus small and mid cap. Most people think that they can still make very big money in a small cap. I think in order to make big money in a small cap, I believe that you need a big crisis. Unless there is a big crisis, it's very difficult to create huge alpha from a small cap. That period was COVID. And whenever there is a crisis, and when you are coming out of that crisis, you can create big alpha, a secular alpha in small caps. Otherwise, in a situation like this, when commodity prices are going up, supply chains are getting distorted, you will see small cap on an aggregate level would find it difficult and challenging to navigate the pressures from margins. And the pricing power for many of these small caps are also limited. The balance sheet capacity for many of these small caps are also constrained. So therefore, in tougher macro environment, large caps are something where actually they're able to gain market share because of their better supply chain connection and stronger growth levers.
Between all this, sir, there is a new offering that you have come up with, the Innovation Fund.
Yeah.
How much of that is completely tech, and what all investing themes are you most excited about in that?
Again, I think Innovation is an interesting fund. It's a diversified fund. It has a combination of internet and technology sector as well. It has a representation in pharma as well. The idea of this fund is to actually look at each and every sector and try to identify what is the innovation which is happening. So if you take an example for an auto industry, it's a very old industry. But what is happening in auto industry in terms of innovation? The trend in last 5 years has been on EV. The other important trend has been on SUV and EV. Apart from that, there has been a trend on hybrid, right? So what happens is that in each of these sectors, and for example, if you take power sector, renewables is a trend, right? Solar is a trend. So what happens is that in each of these traditional sector as well, companies which actually focus on these new emerging trends, they are in much better position to gain market share and grow faster than the rest of their peers in the industry. And so therefore that is an idea. The idea is to invest in those companies which have the ability to identify, pick up these right emerging trends, and some of them could be disruptive in their respective industry, and able to capitalize on these trends and thereby get benefit from this transition which is happening, let's say from coal-based power to renewables, from ICE-based EVs to ICE-based
To EVs.
PVs to EVs,
Hmm.
right? So this kind of trend is visible in many of the sectors, right? There is entire capital good theme in that. That theme partially gets benefit because of expansion of data center. Let's say we want to grow from 1 gigawatt to 4 5 gigawatt in coming years in India. So that entire piece would also have benefit because of this trend in data center, right? So in many of these traditional sector itself, you find a lot of higher growth opportunities, provided that those companies are targeting those niche areas where the growth rates are very high. So that is the broader idea of running this fund.
Because we are talking about, macros and themes and trends. Do you think the concerns around tariffs, the concerns around, the FIA outflows are impacting, and the impact is, the intensity of impact is serious enough to, consider? Because Indian equities had a tough run because of all these things, and then the conflict. So what's your understanding there?
So there, I think as far as FI outflows are concerned, we have seen one of the highest FI outflows in past 5 to 7 years. I think a lot of money has moved in the emerging markets, has moved to, let's say, Korea, Taiwan, Japan,
Vietnam.
because I think these are the countries which are connected with the AI supply chain. So I think the view is that at some point in time, intensity of the capex which we are seeing in AI hardware, that will peak out
Okay.
in terms of growth. Right now, we are still seeing the acceleration of the growth. It can peak out because of many reasons. It can peak out because of issues in supply chain. It can peak out because of constraints on power side, or it can peak out because of lack of sufficient monetization opportunities for many of these AI investments. It can be because of many reasons. So I think a big benefit of this trend, which has been lasting like for past 2 3 years, you will see a big benefit of this trend coming to India. As far as the AI is concerned, where India is largely in the application layer. So India would get benefit from AI trend when it comes to actual implementation of these AI in each of these organizations globally. That is where I think India would have maximum benefit. At this moment, we are not there so much in the supply chain of these data centers. So I think once investor gradually reduce their exposure in Korea, Taiwan, and Japan market for whatever reasons, there I think you will see a direct benefit of FI's reversal. So that is important. Second important thing is the improvement in the macros at these level of oil and so much pressure on the currency. I think it will be tough for us to imagine a big FI flow coming back to India. So it will take some more time and stabilization of these situation.
We spoke about so many industries and sectors, sir. Green energy has had the longest structural runway in the country. What's your opinion on that front?
What is the missing piece is the battery part. So what is happening is that in daytime now we have sufficient supply which is coming from solar, and we would have excess power situation during daytime. The problem is in the evenings, right? And the solution for that is battery storage. So we do not have full answers to that, but I think in times to come, this battery storage investment in battery storage would need to pick up in a significant manner. Thermal would remain a part of that because battery can support that surplus peak demand for 2 hours or 4 hours in the evening. But I think that would be an important part.
So this was all top down.
Yeah.
Most investors either are diversified, either they follow either diversified investing or they follow concentrated investing. You manage a fund which is a focused stock fund as well as a 80 stock large cap fund. How do you double between these two stuff? What's the core thesis between these two styles of diversification, and how are you able to manage?
Most of the exposure in this large cap fund would be large cap stocks, Nifty 100. Uh, the other fund, which is Focus 30, current exposure is largely a combination of large and mid cap. So to that extent, I think there is a higher representation of mid caps in Focus 30. So that is one difference. In Focus 30, you get less flexibility because you are constrained with number of stocks, and the probability of getting the idea right is very, very important there, because irrespective of whatever weights you build in that fund, everything is at least 3.5% because of the design of this fund. So it's more concentrated. Large cap to that extent is a little bit more relaxed. You can have multiple number of stocks. Now what happens is that the buying style is common. The way I think about buying a stock is actually common, let's say, across funds. What I do is that I typically buy stocks when things are not well for them.
Some dislocation.
Some dislocation. It can be a company specific dislocation, it can be a macro dislocation. So the buying opportunities are similar. Of course, the market caps are different, sectors can be different. The only part is that because I need to build significant positions in large cap, the timing of entry, can be little different from Focus 30 to large cap. So I think, let's say, if there has been a dislocation, there has been some, let's say, issue, company specific issue. Because of that, there has been, weakness in the earnings for past 6 to 8 quarters. Now, if I expect, the earnings revision to happen, let's say, in next 4 quarters, that is where I think I actually get interested in large cap. But in let's say in Focus 30, timing also becomes critical. There, I think I a little bit I have to time it better. But in large cap, because I have to gradually build and scale my position, I have to give more time in order to accumulate a particular stock. So that is the difference.
And when we're speaking about the large cap companies, almost every company is well researched.
Yeah.
So where does the meaningful alpha really come from?
There are maybe 3 to 4 sources of alpha creation. One, I explained you the contrarian buying. So buying is important. A large part of alpha is also because of right buying price, because that is something which is in your hand. Outlook and earnings recovery is not fully in your hand. You can visualize it, but so that buying price is important. Second is that I think risk reward. So whenever I am particularly looking at a stock to buy, I am looking at least 2:1 kind of a risk reward, where a majority of the bad news is into the price. Expected good news also not into the price. So that is second part. Third part is that avoid basic mistakes, avoid weaker balance sheet companies, avoid companies with dual leverage, high operating and high financial leverage, avoid companies with weak capital allocation, typically avoid companies with low promoter holding, right? And then other important piece is to get the top down right. So if we get the sector allocation right, that also has an important role in creation of alpha. So if you look at India market versus, let's say, many of the other markets globally, in India market, fund managers create a lot of alpha by getting the sector allocation right. So we have 7, 8, 10 different sectors, and each sector follow some or the other different cycle, right? And to get the macro right, your crude, FX, fiscal, credit, all of these right is also a part of that.
You spoke about the dislocation concept, right? Give me an example of current set of dislocation that you're seeing, and what kind of mean reversion are you planning to have, without naming the specific company.
Yeah.
But give me an example of couple of latest dislocation that you have observed in the market.
See, I think what has gone down in last 1 month in the market are all stocks which have an impact because of the commodity, right? So you look at FMCG sector, you look at automotive sector. Valuations for auto sector would be now closer to what pre-GST valuations were, and one view is that oil would remain high. The second view is that oil will go back to pre-conflict level, and the third view, which is my view, is that oil would settle down somewhere in between, but it cannot be as high as this. So if that happens, then I think then pressure on the near-term earnings, which we are seeing in the coming quarters, would get ease off, right? So that is one example. It can be in automotive sector, it can be in FMCG sector, it can be in other sector. And the second part is that, let's say, if we see reversal of this FI outflow, we see improvement in the liquidity, stabilization in the currency, then I think the fear on the slowdown in the credit growth, that would get eased out. We can become a lot more constructive, right? So I think dislocation can be because of let's say margins, because commodity prices have gone up, and if your view is that it will settle um, at s- at somewhere lower, then that is one sort. The second could be if there has been a growth challenges in recent time, and that those growth challenges can unwind because of some of the other external trigger. So that can be the second bucket. I think if you look, there has been overcorrection in the technology sector as well. So the fear is here again on the growth disruption here. If these companies able to show better growth in their order book, something what we saw in recent Accenture results, then that would definitely get repriced to a better growth number. So stuff like this.
So everybody is talking about the disruption in IT sector,
Yeah.
especially the IT services part. What's the contrarian understanding that you have? How do you understand? How do you predict whether or companies, Indian IT companies, will be able to catch up with the AI revenue or not? And what's the mean reversion concept there? What's the contrarian understanding you have held there?
See, I think the challenge and the confusion which investors have in their mind as far as IT services companies are concerned is their legacy portfolio. So, how fast the deflation can happen in the legacy portfolio. So, I think there are different understanding, and only time would tell how fast it can happen. In my understanding, let's say earlier there was a 10% deflation in those legacy portfolio. That deflation would now increase to, let's say, 20%. But at the same time, what happens is that this deflation of 40, 50, 60% which people talk, it is only in the part of that portfolio. It can be only in part of, let's say, application development, application maintenance. But a large part of the work which these IT services companies perform, it's of a system integration,
Right.
right? So there's a lot of system integration effort which goes beyond connecting these different softwares, technologies within an enterprise, right? So it's not that simple. What I'm saying is that, to put it very simplistically, pre-COVID, this sector used to grow at 8-9%. We saw a very high growth phase of, let's say, 12 to 18% in 2021 to 23. Now, last 3 years, we have seen very low growth phase. I think the reality could be somewhere in between. My reckoning would be that the sector growth rate can settle anywhere between 4 to 6%. It may not reach to high levels of what we saw pre-COVID, and there can be few years where there can be very strong demand of AI related services. We have not still reached to that level. I think based on various studies, it is estimated that 90% of the enterprises globally, large enterprises, are not yet prepared to absorb absorb the AI technology. This is requirement of a lot of changes in their software systems, database, everything. So it will happen over a period of time, right? And I think whenever that happens, you can see a positive surprise also. Right now, it is difficult to time whether it will be next year or it would be after that. But whenever that happens, you can see a pickup of growth for couple of years because of that. The second part is that there is an impact on the software companies because creation of software has become easy. So what we have seen in last 10 years is a journey where SaaS companies have taken away some of the market share from from IT services companies because there has been a softwareization of services. Now the pricing of the SaaS license fee and overall spending by an enterprise on these companies are still quite high. So enterprises are thinking to reverse some of that. They are thinking why don't they create new software from scratch because coding has become very cheap, right? So that is an opportunity which is additional opportunity for IT services companies. We have to see how material that would be, but it can save cost for enterprises. It can create new opportunities for IT services. And the third bucket, which is the last bucket in terms of this entire AI thing, there are a lot of legacy systems which are there in different industries: banking industry, healthcare industry, travel industry. You see, these systems are as old as 1980s, 1990, 2000. They're very old systems, and nobody was willing to update or upgrade these systems because cost of upgradation was very high, and the level of disruption which can happen in your ongoing operations would be also tremendously high. Some of these things are now possible. So that is a third set of opportunity which can come. What is offsetting is the deflation in the legacy business, and what is the positive is these 3-4 opportunities. Timing is still not clear, but I think combination of both of these put together, we can still see, I think, 4 to 6% kind of a growth which is possible in medium term from this sector.
Moving to the last part, sir. You've worked with Mr. Naren for quite some time.
Yeah.
And then in this first series, we are going to host him as well. What are certain things that you have learned from the man?
His ability to actually, decipher macro market cycles, that is something which is very interesting, because I think our behavior is very different when we are investing in a market which is expensive. Our behavior would be very different when we are investing in a market which is cheap. For example, in a very cheap market, I am open to have a very high active share in my portfolio. I am also very open to actually go down in the quality curve. In a very expensive market, my active share would go down. I would increase the quality in my portfolio. I will increase the market capitalization in my portfolio.
Agreed, but this is all generic. Give me a story that you have with Shankar sir, which actually had an impact on your investing style or on your life.
A lot of my investment style is not very similar to Naren, but it is built on the top of something which I have looked at him doing in different stocks at different point in time, and it's a combination of all of those things. So I have my own investment style. I would say that I am a value conscious, but I have a growth bend as well. I am not a deep value seeker, which is something which Naren is able to execute very well over last 25 years.
Awesome. Thanks a ton, sir.
Thanks.
Thanks a ton for sharing a lot of your insights, and we look forward to learn more from you.
Thank you. Thanks a lot for your time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.